Kalorama, a recorded books Highbridge imprint, presents Taxocracy, What You Don't Know About Taxes and How They Rule Your Daily Life, by Scott Hodge, read by Michael Butler Murray. Introduction. It is not often that Congress repeals a tax break for the middle class, but in 2021, when lawmakers passed the Consolidated Appropriations Act, they repealed a $4,000 tax deduction for education expenses. Why? Because taxpayers were confused by it. It turns out that many taxpayers chose to take the $4,000 tax deduction rather than a similar $2,000 tax credit for education expenses, because they did not understand the difference between a tax deduction and a tax credit. Tax deductions reduce your taxable income, whereas tax credits reduce the taxes you owe, dollar for dollar. Thus, for most taxpayers, a $2,000 tax credit is much more valuable than a $4,000 tax deduction. This is a relatively simple case of tax policy gone awry, but bad tax policy can have a much bigger impact on our lives. Taxes can influence how much we work, where we live, how much we save, how much we invest, what products we buy, and how many people a business can afford to hire. Taxes are as much about psychology as they are about economics. Indeed, an entire field of behavioral economics dedicates itself to understanding how we respond to taxes and what strategies tax authorities can use to make us more compliant. Taxes can make us do things we wouldn't normally do, and that change in collective behavior can impact the economy, often negatively. Many of us will go to great lengths for the simple pleasure of avoiding a tax. Who hasn't purchased something online to avoid paying local sales tax, or driven to another town because the tax on soda is cheaper? Yet other times we may not realize how tax policies have impacted things we take for granted. If you get your health insurance from your employer, for example, it is because the fringe benefit was made exempt from federal income taxes during World War II. Because of the likelihood of unintended consequences, lawmakers need to take great care in enacting any new tax changes, as the education tax deduction example reveals. History is full of lessons about how the lack of foresight impacted the roof lines of buildings, the design of vehicles, the clothes women wear, and our choice of snacks. In other words, taxes rule nearly every aspect of our daily lives. Taxocracy means ruled by taxes, and it connotes two concepts that people dread and associate with government: taxes and bureaucracy. We live in a taxocracy. Taxocracy, What You Don't Know About Taxes and How They Rule Your Daily Life, won't help you lower your tax bill, but it will help you understand the different ways taxes influence our behavior and lead to unintended consequences, and why we need a less costly tax system. Taxocracy is meant for taxpayers who have been driven mad on April 15th by the frustration of completing their tax returns and wondered what they are getting for their tax dollars. It is for anyone who has wondered why the costs of health care and college tuition keep going up. It is for anyone who has wondered how their neighbor could afford that fancy electric car. Taxocracy is also aimed at the millions of average taxpayers who worry about the nation's fiscal health and the economic legacy we are leaving our children and grandchildren. The book builds a foundation of understanding through a series of amusing stories of tax policy gone awry. It then explores how the current federal tax code has led to more serious consequences, affecting how we get our health insurance, the price of a college education, what car we buy, where we bank, and in some cases, even when we die. The book concludes with a review of ways the federal tax code can be reformed to take psychology and politics out of tax policy. Part 1 takes an amusing tour through various examples of how taxes have given us tax-free attics, three-wheeled cars, hard seltzer, tennis shoes, posing as bedroom slippers, and a 12-year dispute over the value of Michael Jackson's reputation. We'll learn how the window tax became a tax on light and air and led to wretched conditions for poor tenants, but jobs for bricklayers who blocked up the windows. We'll learn how the chicken tax incentivized auto companies to import cars in pieces, only to reassemble them in the U.S. We'll learn how the luxury tax destroyed the domestic yacht industry and caused a trade dispute over imported automobiles. We'll learn why Bob Dylan sold his song catalog to corporate investors. And we'll learn why the Internal Revenue Service, IRS, wanted the heirs of an art collector to pay $29 million in taxes for a painting that was worth nothing. In one way or another, each of these odd stories provides a lesson that helps us understand how our federal tax code impacts our daily lives and affects the broader U.S. economy. The stories about today's tax code may not be as amusing as the chicken tax, but they are no less important in understanding how different our country is because of federal tax policy. Part 2 digs into 7 broad areas of tax policy, from nonprofits and corporate welfare to health care and tariffs. We'll illustrate how exempting things from taxation can cause as many economic distortions as raising taxes. Credit unions and nonprofit hospitals, for example, hide behind their tax-exempt status to compete directly with tax-paying banks and hospitals. Universities have become big business, collecting more in program revenues, TV royalties, and government grants than charitable gifts from alumni. Municipal bonds encourage local governments to borrow cheaply, but can saddle taxpayers with large debts. Since bondholders tend to be wealthier than local taxpayers, muni bonds can transfer wealth up the income scale. Tax policies aimed at making health care, housing, and higher education more affordable have backfired by undermining the competitive markets in those sectors. These subsidies get baked into the price of the product, leading to higher costs and less affordability. Similarly, state and local governments manipulate their tax codes to maximize federal tax deductions for their wealthiest residents, while shifting the cost of any tax increases to Uncle Sam. Lawmakers' efforts to venture capitalists have been a failure. Purchase of electric vehicles, EVs, for example, don't fully benefit from EV tax credits because automakers soak up the tax subsidies with higher prices in the same manner that universities soak up tuition tax credits with higher tuition costs. Efforts to spur investments in alternative energy sources have created a lucrative tax avoidance market for rich investors and large banks. Ultimately, no amount of tax subsidies can overcome consumer tastes and intrinsic factors such as demographics. Nonetheless, companies are responding to a new wave of green energy subsidies by changing their business models to cater to political dictates, not market signals. This is a recipe for dependency and fragile industries. Efforts to help the poor and middle class through generous tax credits have also generated unintended consequences. The Child Tax Credit, CTC, for instance, was created in 1997 as a $500 tax credit for families with children. It is now $2,000 and has contributed to knocking millions of taxpayers off the tax rolls, while benefiting upper-income families more than low-income families. The Earned Income Tax Credit, EITC, was created to encourage people to move from welfare to work. Some evidence shows it can encourage single mothers to get jobs, but also that employers may pocket some of the subsidies. It also has the highest fraud and error rate of any tax policy, at 25%, costing taxpayers nearly $20 billion a year. The estate tax, or the sunsetting of it in 2010, incentivized people to live longer to take advantage of the lower rate. While the estate tax is justified as a check on inequality, even large estates are asset-rich and cash-poor. Consequently, heirs are forced to auction off family heirlooms, assets, and businesses to pay the estate tax, resulting in the transfer of assets from one wealthy family to another. In one case, the heirs of an estate sold $600 million worth of art to foreign billionaires to pay their tax bill, thus putting those assets forever out of the reach of the U.S. tax system. The tax code has made life difficult for taxpayers and has made administration impossible for the IRS. Thanks to the dozens of tax credits that Washington has created over the past 3 decades, the IRS is more of a benefits distribution agency than a tax collection agency. Unlike most spending programs, tax credits and deductions don't come with built-in metrics for measuring their success or failure. Taxpayers simply claim the benefits on their tax return, and the IRS generally has no way of measuring the efficacy of the program. So when people claim tax credits for tuition, for example, the IRS has no documentation that the taxpayer actually enrolled in college. Rich investors are saving billions of dollars by taking advantage of opportunity zones. But the IRS has no documentation of where those projects were built or how many local jobs were created. Meanwhile, you and I collectively spend over 6 billion hours each year complying with IRS paperwork at a cost of over $300 billion. That is time and money we will never get back. Not all taxes fit neatly into specific categories, such as income taxes or sales tax. Part 3 will explore the inhabitants of the island of misfit taxes. These are very popular taxes among certain wishful politicians who believe that these taxes can solve vague problems, such as inequality or price gouging, while raising lots of revenues to pay for new social programs. Among these magical taxes are the 15% minimum tax on corporate book profits, as a 1% tax on stock buybacks, a wealth tax, a financial transactions tax, and the windfall profits tax. By this point in the book, some listeners may conclude that every provision in the tax code must be a loophole or have some unintended harmful impact on the economy. Fear not. The federal tax code does have some provisions that may look like loopholes and special preferences, but promote timeless virtues such as saving and investing for the future. In Part 5, we will explore the difference between good tax deductions and bad ones, and explain why not all tax incentives are silly, even a tax break for writing off the purchase of a racehorse. Indeed, we'll learn why the same tax deduction that benefited the late TV chef Julia Child should apply to all businesses, large and small. Tax policy does not have to be complicated. There are similar rules of thumb that give us the core principles of sound tax policy and a framework for determining which taxes are more harmful than others. It has been said that since the primary function of taxes is to raise revenues for the government, politics will never be absent from the policy. Perhaps this is true, but there are ways to mitigate political influence on tax policy, such as adhering to first principles and sticking to economics. Part 6 will outline the 4 principles of sound tax policy: neutrality, simplicity, transparency, and stability. With these in mind, we'll show how the tax and growth ranking can guide governments away from income-based taxes to rely more heavily on consumption and property taxes. Over the past few decades, crafting tax reform plans has been a cottage industry among academics, think tanks, and presidential commissions. We will survey some of the more common consumption-based tax reform proposals, such as the flat tax, fair tax, X-tax, and progressive consumption tax. But in the real world outside of U.S. ivory towers, countries across the globe have been implementing pro-growth tax reform. By most accounts, the most neutral and economically competitive of these systems is the Estonian tax system. We will discuss why the Estonian system is such a model tax code and how adopting it could improve the U.S. economy. Finally, the timing of this book could not be more relevant with the 2024 presidential elections on the horizon. The economy slowing under the weight of high interest rates and persistently high inflation, unsustainable federal deficits, the IRS under a microscope, and our divided politics. It is the right time to start a conversation about why we need a tax code that doesn't rule our lives. But the lessons in Taxocracy are not just relevant to the 2024 presidential elections. These lessons are timeless because politicians never stop using the tax code to influence our behavior. So, we must be ever vigilant as to the unintended effects of tax laws on taxpayers and the nation's economy. Part 1. Timeless Lessons of Tax Policy Gone Awry. Economists are fond of using supply and demand charts and complex equations to measure the impact of taxes on the economy. These tools certainly have their place, but it is much more interesting to see how we humans respond to taxes in real life. Stories can often tell us far more about the impact of taxes than a mathematical equation. In econ speak, taxes are a price that governments impose on goods and services. So when a tax is applied to a good or service, the higher price will reduce consumer demand, resulting in a drop in supply. This is what is meant by the economic truism: when you tax something, you get less of it. But getting less of something can also mean getting more of something else, and that something is typically tax avoidance. What makes tax policy so interesting is the creative ways in which people avoid taxes and the economic consequences of those actions. The stories in Part 1 are about the creative ways people and businesses respond to taxes, often contrary to the way policymakers intended. Our first vignette, Tax-Free Attics and See-Through Buildings, is a story about how taxes can affect the shape and function of things. For example, when governments taxed the width of buildings, people stopped building wide buildings and designed narrow and taller ones instead. When British King William III enacted the window tax, building owners responded by bricking up their windows. Indeed, some buildings became windowless and thus tax-free. However, the elimination of windows in many apartment buildings leads to the spread of diseases such as typhus and dysentery among the poor. The human toll of taxes is difficult to illustrate with a simple supply and demand chart. Governments often try to use so-called sin taxes to discourage certain behaviors that are seen as harmful. However, discouraging harmful behavior and raising revenues are contradictory goals, as is illustrated in "Have some baked chips with your hard seltzer." Sin taxes are notorious for incentivizing avoidance activities, such as cross-border sales, bootlegging, smuggling, and substituting one vice for another. This makes sin taxes a very unstable source of tax revenues. And not only do these taxes often fail to achieve their purported goal, such as reducing obesity, but sin taxes are also regressive. Taxes have not only altered the shape of buildings, but they have altered the shape of the auto industry. Three-wheeled cars and chicken taxes tells a story about how tax differentials can incentivize creative avoidance and disrupt global trade. For example, the UK road tax applied a different tax rate to vehicles with different engine sizes. So one manufacturer designed a three-wheeled car that was taxed at the same lower rate as a motorcycle. The 1960s-era chicken tax on imported light trucks still gives U.S.-made light trucks a competitive advantage. It is one reason for the proliferation of pickup trucks and SUVs. The luxury tax, enacted in 1990 on autos, yachts, and jewelry, discriminated against imported cars and sparked a trade dispute with our major trading partners. The pink tax, and women in children's clothing, is a story about how the arbitrary application of taxes can be discriminatory in some cases, while providing opportunities to game the tax code in others. In the U.S., the arbitrary application of tariffs on clothing disproportionately raises the cost of women's clothing over men's apparel. But in the UK, The exemption of children's clothing from the value-added tax, VAT, has encouraged some petite women to purchase their fashion in the teen section of department stores. Individual income taxes are some of the most harmful taxes for economic growth because of how they impact our decisions to work, save, or invest. In the story, The Not-So-Fine Art of Extracting Taxes, musicians such as Bob Dylan and Bruce Springsteen provide an excellent example of how people can be motivated by just the prospect of a tax increase. In their case, the musicians were trying to avoid President Biden's campaign promise to raise the capital gains tax. They did so by bringing income forward after selling the future rights to their music catalogs. Corporate taxes, or taxes on capital, are the most harmful taxes for economic growth because of how mobile capital is in the economy. The story on the stew tax illustrates how taxing the excess profits of companies during World War I and World War II became a tax on brains, energy, and enterprise, according to a former Secretary of the Treasury. Let's take an assuming tour through some of the ways in which tax policy has impacted our day-to-day lives, from the design of our houses to the beverages we drink. 1. Tax-free attics and see-through buildings. Imagine getting a call from an investment advisor. She says, "Have I got a great investment opportunity for you? I'd like you to invest $10,000 in this office building. It's currently empty, and we have no intention of leasing it out. In fact, the more we lose on it, the more you get to write off your income taxes. It's a deal of a lifetime." Sounds like a scam, right? Wrong. During the 1970s and 1980s, investment advisors pitched all kinds of schemes to shelter income from federal taxes, including investing in empty, or what critics of the savings and loan industry called see-through, buildings. I remember my middle-class parents listening to a sales pitch to invest in dry oil wells. They didn't invest in one, but people could become passive partners in similar investment opportunities. Because of the nature of the partnerships, the losses were passed through to the investors, who could write them off their income taxes. The Tax Reform Act of 1986 shut down schemes such as these, taking with them many of the savings and loans that got overextended funding such projects. Taxes have impacted the design and functionality of the buildings we live in and work in for centuries. One of the oldest known houses in France is a rather unusual dwelling in which the second and third stories are considerably wider than the first story and cantilevered over the road running next to it. Why? Because during the 15th century, property taxes were based on the square footage of the land a house occupied. So, people cheated the tax collector by designing a small ground floor level and wider stories above it. Perhaps the most famous tax-free additions to buildings were the mansard roofs that became the iconic style of apartment buildings in Paris. During the 17th and 18th centuries, property taxes were assessed on the height of buildings below the roofline. Landlords wanted more rentable space, so Parisian architect François Mansart designed a livable attic-like space set back from the official roofline of the building. Landlords could then rent out these livable spaces, tax-free. It became such a popular style that when Georges Eugène Haussmann redesigned the layout of Paris in the 1850s, he made the roofs the official building design. Mansard roofs are now very common throughout the world, including in the U.S., but are probably no longer tax-free. One way to avoid a tax on a building's width is to build it taller. Taxing the frontage, or width, of buildings was very popular in many European cities, especially in cities such as Amsterdam and Copenhagen, where there was limited land facing a canal or port. To get the most out of a small space, architects designed narrow but tall buildings that now add to the charm of those cities. But tall and narrow buildings do have many drawbacks, such as getting furniture up narrow staircases to the top floors. So pulley systems had to be installed at the roofline to hoist furniture to upper floors. Today, furniture is delivered to the upper floors of these old buildings by conveyor-style lift ladders. The lesson here is that not only did taxes impact the design of buildings, but they also sparked a collateral industry to cater to the unique design. Another way to avoid a tax is to never finish a building. Visitors to Egypt are amazed by the antiquities as well as the sea of unfinished but inhabited homes and apartment buildings. In some neighborhoods, every building seems to have iron rebar rising from the unfinished top floor or missing glass where the windows should be. Egypt's 1950s-era property tax law is another example of incentives gone awry. The law, which has since been updated, levied a higher tax rate on finished buildings than unfinished ones. It seems intuitive to tax buildings under construction at a lower rate than completed ones, but that differential incentivized Egyptian property owners to never fully finish construction on their buildings. Homeowners could always claim they were waiting for the kids to get married to add a second-floor apartment to the family home. And since it rarely rains in Egypt, what apartment needs glass in the window frame? Camouflaging your pool may not escape the high-flying tax assessor. In countries such as Greece and France, a backyard pool is considered a luxury improvement to the home and can subject the owner to higher taxes. In France, adding a pool to your property must be declared to the tax office within 90 days of completion. In Greece, pools, airplanes, and pleasure boats are subject to a luxury living tax. Taxpayers must pay tax on the value of such possessions, but the tax implications don't stop there. They also must use the value of their possessions, say a pool assessed based on its size, as a check on their tax return. Does the income they report earning match the income of a person who could afford such a luxury? In both countries, pool tax evasion is so rampant that authorities have resorted to extreme measures to find unreported pools. During the Greek financial crisis in 2010, tax assessors used helicopters and satellite photos to identify nearly 17,000 unreported pools. Homeowners often go to great lengths to camouflage their pools, including painting the bottom green to make them look like lawns. More recently, French tax authorities used AI software that compared aerial images to land registries to find over 20,000 undeclared pools. However, the software is not foolproof. It has mistaken solar panels and dog kennels for pools. Taxes are not always the cause of building designs. One of the more iconic home designs in America is the single house, found in Charleston, South Carolina. The homes are narrow and long and typically have a porch running down the side of the building. It is commonly believed that the homes were designed this way to avoid frontage taxes, but there is little evidence of that being the cause. A similar urban legend surrounds the shotgun homes in New Orleans. Historians find no evidence that their narrow design is the result of a property tax on the frontage. The perseverance of such legends, however, tells us people intuitively understand how taxes can influence such things as home design. Taxes aimed at the rich often hurt the poor and lead to ugly architecture. Some of the most infamous taxes in architecture are the window taxes that were levied in England, Scotland, and Wales from their introduction in 1696 to their repeal in 1851. King William III enacted the tax to replenish the government's coffers after a war and subsequent currency devaluation. The tax was intended to be an indirect tax on wealthy property owners under the theory that the more windows a dwelling had, the wealthier the owner must be. The tax was progressive, so the more windows the home had, the higher the tax rate owners paid. Economic historians have called the window tax a tax on light and air, and report that the tax led to especially wretched conditions for the poor in the cities, as landlords blocked up windows and constructed tenements without adequate light and ventilation. Some buildings were constructed with no windows on some floors, leading to the propagation of numerous diseases, such as dysentery.
Sample complete. Ready to continue?